Bloomberg Audio Studios.
Podcasts, radio, news.
Leaving behind a February full of tech-fueled stock market records, Steve Wieting of Citi expecting the broader market to close the gap on big tech, saying this: the extreme divergence of large-cap tech profits from other industries should diminish this year and next. We would not be surprised if Mag 7 EPS gains in 2024 were cut in half on strong investment spending and greater competition. Steve joins us now. And Steve, that's a lot to get through. Can we build on that just a little bit more? Well, you're expecting some of that gap to close.
If cut in half means 20 to 25% EPS gains, that's still substantial growth. You know, industries that are literally booming, and there's probably a very limited number that are doing that. Booms you worry about on the other side of those sorts of things, but they're not going from large gains to declines. They're going to a bit of a slowdown. And, you know, again, look at Mag 7. There's probably 4 companies that are buying up every microchip that they possibly can to offer AI services. Now, there's an open question as to whether these services, again, are going to find demand in the economy from just about everywhere, that they're not going to compete with each other, and they're really going to all be able to boom together, or will they compete and they will narrow down profits? I think, again, we're not willing to give up diversification in portfolios, right, to just bet on that single trend. And so, again, a lot of other good things are happening in the economy. We're raising our economic forecasts, raising S&P EPS forecasts, and seeing industries that have been weak for the last year and a half bottom out and begin a recovery. They won't do as well as Mag 7 in terms of EPS gains, but hey, they're at a very different valuation.
You're clearly not bearish. You're overweight equities, small, mid-caps. Talk to us about the industries you like right now.
Well, again, you can get mid-cap growth companies in the United States for about the same valuation as European shares. Only the U.S. mid-caps have grown at about 11%, and Europe has grown at about 2%. I think we increasingly want to swerve towards healthcare, something that's been out of favor with the exception of GLP drugs. Equipment makers have had a historic growth rate of 9% dividend growth for 3 decades. They're trading 15% off of their highs. And again, a lot of people thinking that we'll never do anything in healthcare except lose weight, which I wish I could.
I will say that a lot of people are working on that. I'm curious about the idea that everyone seems to be shifting to this idea that earnings are coming better than expected. The U.S. economy is more stronger than expected. Fiscal keeps on supporting everybody for the foreseeable future. So why is it that cash funds are on pace for another year of record inflows? People are talking about cash is trash. I don't think so. People love their cash funds, and they are plowing more money into them.
So look, the reason why we're not more overweight equities is a great competition from yield. And so we want to participate in that. Our bond portfolios have a little bit below average duration. We expect, again, to earn that longer than the Fed will stay at 5.5%. But this is good competition. And look, we've been bullish for a while. We've seen increasing bullishness. We've seen new shorts being set in the equity market. Everybody is bearish in the bond market and extremely short the bond market. I think that there are some areas which have been so strong that we want to just start to ease back from them. When you've had 80% returns in software, for example, it just is time again to just start to shift to some of the other areas. But there's room for both stocks and bonds in portfolios right now.
This doesn't sound like a market that's been drained of liquidity. It sounds like an economy that is flush with liquidity. Why has the Fed been so ineffective at draining this market of liquidity?
Well, again, do you have to? Must we have a new recession, again, to stop this rapid inflation? I think we have another troubling inflation report that's going to come in March for the month of February. It's going to be another reason for everyone to again say, well, wait a second, maybe we're not on this disinflation trend. Maybe we're going to be stuck here with the Fed doing QT and 5.5% funds. That's possible over the short term. But the reality is, the good news has been we've been able, again, to get supply and demand to line up a lot more in a stable way without a massive surge in unemployment. Now, if we get too excited about that, there's going to be some problems.
You've upgraded growth. What do you see? What do you like? What's leading to that?
Well, I think, again, it's weaker pieces of the economy. We've had a hidden recession underneath the surface. If you're looking at Germany, if you're looking at Japan, if you're looking at China, if you're looking at manufacturing in the U.S., which is nobody would really look at, but the reality is it's contracted for the year behind us. Trade contracted 8% in the year through the third quarter of last year. And these weaker components, again, are moving into a more stable, growing place. Probably not going to be anything V-shaped, but it's those things along with large cap tech, with AI, which is in the boom.
There's been a big spread between manufacturing and services for quite a while, as you indicated, over the last year, 2 years. Manufacturing started to come up to services. Is that how you expect that story to complete?
But remember, it will come with a very different labor market outcome. Services, labor intensive, manufacturing automated, right? So the headcount differences are going to be really, really substantial. The services industries can't keep adding 200,000 jobs per month just in those industries, right? So you've seen a halving in employment growth from where we were 2 years ago, when services just turned right back on like a light switch. Again, hospitality, airlines, travel, all of these things, incredibly labor intensive, and we had massive job losses there to recover. But now we're at the point where I think it'll slow down. And it didn't in the month of January. It was 353,000 jobs in January, but we saw seasonal distortions in employment, inflation, retail sales, all of these things in different directions. It's going to take a while for the market to sort it out. I think we'll be a little more worried before we start to really come to grips again.
John mentioned your upgrade of U.S. GDP. Mohamed El-Arian recently in Project Syndicate was talking about what happens in the United States matters to the rest of the world, doesn't stay in the United States. Do you foresee then U.S. growth, if you see it picking up, helping the rest of the world?
It is, but it's challenging at the same time because, again, the amount of time that we spent with restrictive monetary policy is still going to be a bit longer. We haven't changed our mid-year estimate, really, but, again, confidence that we're going to have easing, the communication of easing through markets, right? We could set that back some. So the dollar has been stronger. Now, that both helps and that hurts. Yields have risen this year, right, at the long end of the curve and across most of the curve. So those are modest challenges, while some of the things are really helping. Consumer demand has not collapsed, and producers have been underwhelming, and they've been really short in terms of meeting demand.
Hey, Steve, it's good to see you.
Thank
Always
you.
great to catch up. Thank you, sir. Steve Wieting there of Citi.